are the key numbers here for investors? Let's bring in Rich Ross. He's the Senior Managing Director and Head of Technical Analysis at Evercore ISI. Rich, does today's trading have any significance to you?
Yeah, I think it reinforces the current themes and trends that, unfortunately, we've been working on here for weeks and months. Look, let's be clear. This is a financial crisis chart book in search of a crisis. And if we don't stop going down soon, it's going to find one, Kelly.
So talk through what the implications are for investors. We spoke to Carter Worth last hour, who was starting to sound a little bit more constructive.
Yeah, well, I'll tell you, we're seeing historic moves across asset classes vis-a-vis straight lines higher in crude oil, interest rates, mortgage rates, credit spreads, gasoline, and inflation. And when those things go up in a straight line, stocks and consumer sentiment have a propensity to go down in a straight line. As a habit, I don't buy things that go down in a straight line, nor sell those that go up in a straight line until those trends have displayed evidence of exhaustion, which is not readily apparent in the charts as we speak. So I'm not quite as sanguine as we speak here today.
Sure, and he wasn't going off the charts yet, but almost more of a hunch, if you will. All right, the Dow, the K-Web, and Apple. We have three, sort of the market overall, particular segment of it, and a stock that you're watching here. So for the Dow 30, what do you see?
Yeah, well, look, we know that the Dow has held up better than the S&P by virtue of its constitution with less technology and growth. When we consider the two of the top stocks in the Dow, which make up 15% of that index, are United Healthcare and McDonald's, they have a more defensive hue to them, down 9 and 11% year to date. Compare and contrast that with the S&P, which is still very tech heavy, dominated by Apple, Microsoft, Google. I think we're familiar with technology and the stocks that dominate that. So again, we can take a little comfort from the relative outperformance of the Dow versus the S&P. But again, when I take a holistic view at the sum of the charts, as it were, this is not a world in which the Dow only goes down 18%, and that's where we are today. So again, 29 is a line in the sand, 29,000 that is, but I do not expect us to hold here if we continue down this course across asset classes, and my work would suggest that we will continue to go down this road.
How long and how far? And I think you make a really critical point that we have to remember. The Dow is a price-weighted index, so a highly priced stock like United Health counts for a lot more than a lower-priced stock.
Yeah, Tyler, look, you've hit the nail on the head here. Any bottom is a function of price and time. In the old-timey days, it used to be a function of price, time, and Fed policy, which has essentially marked the low of every major market decline in recorded history. But in the absence of Fed policy support, of course, in the presence of inflation at a 40-year high, price and time are going to take longer in terms of both magnitude and duration. And I would put forth that here we are just 6 months from an all-time high, Tyler. And again, we went up for 13 years and we've gone down for 6 months. So for my work, the punishment still doesn't fit the crime. This one's going to take a little longer to work itself out without that help from the Fed.
And you'd still be a seller of Apple here, Rich, but you are a buyer of the K-Web, is that right?
Yeah, this is really interesting because in this macro maelstrom, if you will, China has been somewhat of a port in the storm. And consider, if we think back to 08, and no one likes the sentence that starts with 08, emerging markets in China bottomed months before the S&P bottomed in March of 09. And I think history both repeats and rhymes here as it pertains to Chinese internet names. Back in March, you saw that crescendo low on the controversial call from a competitor. And again, we come back around and retest that low, only to put in a critical double bottom, which provides the catalyst for a breakout above that 20-week moving average. And I can tell you that what gets you out of a trade gets you in. Look at the break below that 20-week. That came early last year. Here we are 18 months later, reclaiming the level which defined resistance for that downtrend. I love the double bottom base breakout. I like the idea of that, which led us lower. China now leading us higher. But again, don't take comfort in that as a U.S. investor, but do take comfort in that if you buy Chinese internet stocks.
Well, like you said, China bottomed before the U.S. that time around, so I'm going to leave it on that glimmer for us now today. Rich, thanks so much.